All right, I guess we're good to go. Pleasure to be here today. I appreciate the opportunity to come visit with us. What I want to do today is talk a little bit more about the marketing side of the grain business, and then we can sort of explore some of the macro-related issues. I know certainly from our own perspective, we look at a lot of the localized issues that are affecting our marketplace. There's, again, the Western Canadian or national issues that are affecting the value of our commodities. Then, of course, it gets into the broader perspective as well from the global markets. And sometimes ag markets tend to get affected sometimes by things that aren't even related to ag at all. The macroeconomic related issues. And those are always difficult to quantify sometimes when we talk about the U.S. fiscal cliff issues and European debt situation and such, and how that affects marketplaces. Especially nowadays that the large pools of speculative capital that have invested in commodities, especially over the past 10 years, has grown so exponentially that they are involved in all kinds of commodity trade, whether it's the energy side, the metal side, ag side. So this ebb and flow of risk on and risk off that can cause investment in and liquidation out of commodities can also have a great deal of impact on our marketplaces. So but it also kind of, is a situation that can create a lot of potential for misinterpretation as well. Trying to encapsulate what this may mean for our ag markets, because we honestly don't know. We don't know how the U.S. fiscal cliff situation is going to resolve itself. And that kind of misinterpretation kind of reminds me of a story a little bit of a husband that's having a lot of difficulty in his relationship with his wife. They're arguing and all the time, and there's a lot of friction between the two of them. So he finally figures one day maybe we'll go visit with a counselor and perhaps maybe get some ideas and maybe what I could do a little better. So they talk for a while, and the counselor finally says, well, if I may suggest, I suggest that you run 5 miles a day, every day for a week. And then give me a call and we'll talk a little bit about how you're feeling. So a week goes by and the counselor gets a call from the husband, and the counselor says to the husband, well, how are things going with you and your wife these days? And he says, well, how should I know, says the husband. I'm 35 miles away. Lots of room for misinterpretation when we look at situations in the marketplace. In terms of the big picture issues, and I won't spend a great deal of time on this because we could talk a lot about this, but I get the sense that while there is a lot of friction, say, between the United States, between Republicans and Democrats, their debt-related crisis is significant, has the potential, at least threatens, to push the U.S. back into recession. All of this goes back to the core of demand. And that affects agriculture, it affects the manufacturing sector, it affects energy, it affects metals. When there's a sense of demand is going to start slowing down, people lift positions out of their commodity positions, out of their equity markets and such. It could have a very detrimental impact that sideswipes the industry, as it did in 2008 when the financial crisis started, and it wasn't borne by the fundamentals of agriculture, but agriculture got dragged down with everything else. So that potential is there. I like to think that while there may be not the truest and ultimate answer to the U.S. debt crisis and the European debt crisis in the near term, even though there's a hard deadline here for the U.S. fiscal cliff, I think some kind of an agreement's going to get cobbled together. So I think we are going through a period here of U.S. consumer confidence, as you see in this graphic here, has started to go up. In 2008, that's when you saw the major decline, and I guess the major decline in consumer confidence as we went into that recession. We're slowly getting out of that. The housing sector in the U.S. is starting to come around again. Manufacturing is starting to pick up. It's not a case where we're going to look for a large recovery in the marketplace. It's still a slow and grinding economic recovery. But I don't think we're going to get the same surprise effect that we got in 2008, where basically the world was shocked by the circumstances that caused the financial collapse and move into recession. I don't think we're in that kind of scenario. I think in today's world, we're more appreciable in understanding of the difficulties on the economic front ahead of us. So I think agreements will be struck and we'll continue the slow and grinding process ahead, which is going to be a good thing relative certainly to the alternative of what we saw in 2008. As it pertains more strictly to agriculture, though, I think one of the things we have to bear in mind is what got us to where we are today. You know, I can think back to 2010, the FSU, former Soviet Union states, Russia, Ukraine, Kazakhstan, suffered a huge drought that impacted that marketplace and moved the wheat market up aggressively in that year. In 2011, yields were below average in the U.S. for corn and soybeans, as well as in South America. And a year ago, the South American soybean crop came in far less than was anticipated, record acreage, but the La Nina effect impacted soybean yields then, and of course we got into the summer, this past summer, where the U.S. suffered its worst drought in 50 years. And Europe and FSU also had problems with their crop production. So what we've seen is almost an unprecedented succession of crop problems in major production zones across the globe for the past 2 or 3 years. And that's what got us to the kinds of prices we saw, the highs we saw in the summertime, and even at the high prices we do see in a lot of these ag markets today. So what's your expectation for the future? You know, all of this is known in the marketplace now. The marketplace now is shifting to adjusting itself. I understand what the problems are on the supply side, what the constraints are now. I'm adjusting the demand side of the marketplace now. And that process is already ongoing. So if you want the next run-up to the next high points of the marketplace, return to the highs we've seen and go beyond, I suspect we're going to need a fresh, new bullish catalyst in order to do that. Whether it's a crop problem in South America and the crop that's now in just getting in the ground, or whether it's this situation in the U.S. or elsewhere in the coming year, you have to bank on that to get you to the next level. And for that reason, because I hate being in a position of hoping for crop-related problems somewhere in the world to take me to the next level. We're already at prices that have gotten into the 90 or 95 percentile of historical trading. I'm already fairly aggressively sold on a lot of commodities. I'm about 70–75% sold on everything. Wheat, barley, canola, flax, oats, peas. Not because I'm bearish, because there's a lot of potential threats in the year ahead, certainly, but because we're such at a high price now, a profitable pricing opportunity, and we need new bullish catalysts to take us to the new level, and more of them to take us to the highs that have never been seen before. I think selling at profitable prices has been a good alternative for us. Now, there are issues ahead. This is the U.S. drought, which was in the Midwest, is being somewhat resolved, but you could see where the dark red is now in the U.S. plains. That's basically affecting the hard red winter wheat growing areas of the United States. It's a significant issue. I don't want to put too much stock in it at this time, because I don't know how many years I've seen where there's been problematic issues, too wet, too cold, too dry, or otherwise in that region. A couple of well-timed rains in the springtime when it breaks dormancy, and that crop can still flourish. Admittedly, the current crop conditions of the U.S. hard red winter wheat crop are the worst since USDA started doing weekly condition reports about 20–25 years ago. It's the worst to this time of year. So it is a serious problem for sure, but like I say, wheat is a weed, and it can recover if given the right set of circumstances. So that is sort of one of those lingering issues that's underlying support of the market right now. Here in Western Canada, dryness issues are prevailing, but they certainly have improved a great deal relative to about a month ago, where that big, that small red spot there in central Saskatchewan probably encompassed, you know, this entire dry region before the last round of winter storms had rolled through. So, and even in Manitoba was looking very dry up until the last couple of big snowstorms we received. So conditions there have improved, but certainly ones will be watched for as we get closer to the spring seeding. Okay, wheat. The world of wheat marketing has changed. And I know when we got into this changed world of the lifting of the monopoly of the board in an open market trading environment for wheat, there was a lot of concern in the marketplace about how this was going to be affecting growers, and growers are certainly concerned about scenarios of grain companies taking advantage of the farmer and such. Well, fortunately, I think the transition, with some logistical bumps, has happened relatively smoothly. And fortunate for us all, it happened at a time the market was bullish. We were in a bullish cycle. If we were in a bear cycle when this transition happened, we probably would have had more second guessing as to whether this was the appropriate decision for us. But I think this aids in the transitionary process, so I think for the most part, things are progressing reasonably well into the new market without too many hiccups. The world wheat situation, you can see in bars here is the world production, the line is the consumption, and in this past year we've seen the production level fall well short of anticipated consumption for this year. And in a nutshell, ending stocks will be declining. Again, we've had this consecutive run of crop-related problems in major production zones that have happened the last 2 or 3 years, almost unprecedented in its scale, has affected levels of production here on wheat, but other commodities as well. The anticipation for next year, though, is this last bar is production is going to start ramping up again. You know, you're not the only guys in the world that are looking at $8 and potentially $9 hard red spring wheat prices. You know, these kinds of high wheat prices are prevailing throughout the planet, and growers around the world are taking notice of it and probably going to see a major transition or a big jump in terms of wheat acreage potential for next year. How that works out to production, that's yet to be seen. But certainly the potential is there to grow a lot more wheat, and wheat is one of those commodities that can replenish itself faster than any other because it's grown everywhere in the world. There's a harvest going on every month of the year. So ending stocks in yellow for this year are down. In red is the first anticipation for next year, some growth. But even in for the current year in yellow, we're not down at the extraordinarily tight levels that we saw in 2006 and 7 and 8. You know, we have come off the highs in terms of ending stock projections, but we're not super tight in terms of wheat supply from a global perspective. What I do like to focus on a little bit, though, is the major 6 players. You know, we grow about 670 million tons of wheat each year. Most of it is consumed within the country it's produced. But 120 million tons of that total is what's actually loaded on boats and shipped somewhere in the world. And these are the 6 players that make up about 85% of that business. And so when I look at them, I can see certainly a deterioration in terms of wheat, and is certainly an underlying supportive issue to the marketplace. And in today's world, the market is thinking that the former Soviet Union states like Russia and Ukraine and such, who have been very aggressive wheat marketers from about August up until now, with the shorter crop that they've had, there's a sense in the trade that they're about to run out of supply, their exportable supply, and are going to be curtailing to hold product in for their domestic markets. They haven't put official bans in place, but they've certainly signaled to the trade in their own marketplaces that we've reached levels where we have to pull back. Now, the marketplace reads this and thinks, well, if the Russians and the Ukrainians are cutting back, and they tend to be a low-cost provider to the marketplace as they have transportation logistical advantage to, say, Middle Eastern and Asian markets, say, relative to us on the prairies, which costs a lot more to get to those destinations. They also undercut the marketplace. They tend to be the low-priced provider of the market. Tends to be lower quality wheat, but nonetheless they sell it cheap. And so they've basically usurped all the export business, or a great deal of it, during this time frame. But if they're running out of supply, the marketplace is going to have to go elsewhere, presumably North America, to get more inventory. And that's the position the trade has been going on, and that's the underlying support of the wheat market right now. The low-cost seller is out of the market. You'll have to come to us now. And that's the sense that the anticipation we've been waiting for in the marketplace. But I also look at where wheat futures have been relative to where we are today. And you can see 2008, we were literally off the chart where we spiked to as high as $20 a bushel for an extraordinarily short period of time, just a matter of days, and then came straight back down again. But in today's environment, relative to history, again, we're in this 95 percentile of where the wheat market is traded. And I always feel much more comfortable marketing increments of product into rising markets, specifically starting when I'm making a profit. I have no idea where the tops of these markets are. Nobody does. And then anyone that thinks they can do that, that's because they're probably more lucky than good. Because there's just so many variables yet to come that we just can't know ahead of time. So I've been pretty aggressive in marketing wheat. I've been about, like I say, about 70% sold here on old crop. and actually start on new crop, but I'll mention that in a moment. But this little portion here, right at the end of the graphic, that's focusing in on where we are today. And you can see the big rally we saw into the summertime as the U.S. drought gave the market its momentum. And then we flatlined since about July or so, trading a very confined range in wheat. Underlying support has been there on expectations. The industry is worldwide. End users are going to have to come to North America eventually to buy our wheat. But there's also been a marketplace that has been very resistant to making any significant move to the upside. No indication of an upside or downside breakout in this environment. I thought we may have saw it about a month ago, where this is the Paris Matif wheat futures market. About a month ago, it broke above that overhead resistance, and I thought, well, maybe this is the signal of FSU supplies running down, European supplies also on the relatively short side running down exportable supply, and the market started to make a move, but it hasn't done so in absolute convincing way in my mind yet. So, like I said, when I've been looking at wheat prices of $8.40, $8.50, say a hard red spring, has been as high as $9, I've been inclined to wanting to market into that environment. Not that I'm necessarily bearish. I know that U.S. hard red winter wheat crop is in dire situation right now, but we don't know what it's going to look like when it's really made or broke in that May or March, April, May period. So been doing some marketing on that one. On new crop, I've done my first 20%, say on a hard red spring wheat, when we're seeing over $8 a bushel, maybe it's $8.30 a bushel or so in today's world. I also look at things like the mid-quality wheat, CPSs and such. Say CPS red, that's around $7.80-ish or so. I look at these as, again, not because I'm bearish, but because I feel I can make money growing wheat at these prices. These are very attractive prices to me. And if we do get the surge of wheat acreage going in the ground next year and normalized production, then the potential certainly is there for this market to start to see some downside that we are kind of fearing may happen 6 and 8 and 12 and 12 months from now. So just some caution there. We have high price expectations built into our mindset, but it doesn't necessarily mean they're going to stay there once we get the world production cycle back on track. Feed grains, corn. In red, you could see the production of this past year. Again, the worst drought in U.S. history in the last 50 years. 10.7 billion bushels were produced. Certainly when we went into the last spring, the U.S. corn crop was looking in fantastic potential shape. We had good moisture conditions through the U.S. Midwest. We had a lot of precipitation, good soil moisture conditions. We had an early start to the planting season. The expectation was over 14 billion bushel potential. Well, it came in about 4 billion bushels short after the drought of July and August devastated the corn crop in the U.S. Oh, but again, next year, the potential is to grow significantly again. Certainly there's talk of increasing corn acres next year, 97 million acres, largest corn acreage in U.S. history if it goes in. But I also look at it from the yield perspective, and you can see here where yield fell well short of what has been, due to the efforts of farmers and better farm management practices, better genetics that have been developed in corn over the last 25, 30, 40 years. You could see that there's been a steady trend line higher in terms of average yield per acre. And this past year fell well short. And the last year before that was a little below average as well. But this was the devastating year this year. But what I've noticed, and this is just theorizing on my part, every time that there's been a below average trend yield, the next year, what does it do? Jumps right back up to the trend line and over in some cases. I'm not saying that's what's going to happen this year. History doesn't tell us what the future is going to be, but it's happened enough times that it makes me wonder. Part of the reason here, again, on feed grains, I've started to get aggressively sold on these things just because looking down the road, that potential is there. It's no guarantees, and I can't give you any hard numbers on this. You know, it makes me think that, why did God invent the market analyst? To make the weather forecasters look good. I can't give you the hard number as to what it's going to be, but I look at the variables that are shaping up and act accordingly. So ending stocks this year, again, extraordinarily tight on the corn. And even on this old crop, I have some suspicions that this is not the end number of all. When I look at what USDA has done over the past 15 years, there's been 5 of those 15 years where in the October and November USDA reports, they've pegged U.S. corn carryout below 1 billion bushels, below 1 billion bushels. By the end of that marketing year, on average, they've added another 300 million bushels to whatever that number was in October, November. Not because they found any more corn, but because the demand side had started to adjust. So this number, I was telling my clients, might be the smallest number we see for this year. It may get adjusted as demand starts to adjust, and certainly if the corn crop turns out as big as what is the potential next year, any stocks could rise. But again, that's an unknown right now. Demand is adjusting in today's world, though. Ethanol that was producing about 900,000 barrels per day has now dropped off to about 800,000. There's adjustment in demand there. Export market share for the U.S., of course they're going to export less because they have less corn to sell. But their market share is eroding as U.S. is the high-cost provider to the marketplace, and fewer interested in buying U.S. corn. And you also have it from the livestock sector as well, as we've had a rationalization in cattle, in hogs, the number ahead in the United States. That is affecting the number of animal feed units. So we look at a corn market. This is March corn futures. Again, the big spike up in the summer rally. Fundamentals are there. The speculative community piles in speculative cash into the marketplace, sometimes taking markets beyond maybe what is fundamentally justifiable in sometimes. But nonetheless, we had a great start to the summer rally. It fell off when it peaked there in about August or so, and now is just trading a range. It can't really go down in any significant fashion because U.S. corn supplies are tight. The last thing you want to do is lower the price of the corn and inspire new demand for supplies that aren't there. So this underlying support is there, but the market is having difficulty making money at $8 corn, whether it's in the livestock sector, ethanol, export. The trade is kind of drawing a bit of a line in the sand there. In order to get this market going again, it needs a new catalyst. And that catalyst could be the next production problem if it's South America or the United States or elsewhere. But if supplies do tend to come back online from these major producers in the year ahead, we will probably be looking at a corn price a little bit different than what we're looking at today. We may be $6 corn, we may be $5 corn. That potential 12 months from now is there. Again, think about where we are from the historical context. We traded even higher than the 2008 market cycle. So we are in, when we tapped above $8 a bushel on corn, we are at the very top of where this market is traded historically. Could it go higher? Absolutely it can, but it needs a new catalyst. We know all the supply issues of the past year. That is in the market now. The adjustment to demand, that is happening now. It needs a new catalyst to get us higher. Barley has been starting to edge higher, but overall, last 15 years, and again, that corn thing is sort of the backdrop to our feed grain market here in Western Canada. But you can see that barley acreage over, say, the 15 years has been steadily eroding. It's been less profitable for growers, better economic options to grow canola or pulses or alternatives. Barley has not been a candidate for most growers in most cases. But I think we are probably looking for a turn of cycle here that we haven't seen in an awful long time, where I think, given the problems that farmers had, for instance, with rotations on canola, whether it was aster yellows, the heat blast that affected the crop, certainly out east in the summertime, some of the swaths that harvest got blown away. There was disappointment amongst growers, generally speaking, in a lot of parts of Western Canada, not as much in Alberta, but certainly in Saskatchewan, Manitoba, that had yield disappointment last year and have pushed their rotations very aggressively. I think we're probably going to look at some shift. I think we'll see some acres come out of canola. Maybe it's not a lot. Maybe it's 10% or 15% or some. But we're going to see more shift into barley and likely into wheat as the economics on those fronts are looking a lot more attractive than we can have seen in a very, very long time. But nonetheless, we're tight on supply on barley. There's no question about that. Ending stock supplies are tight, and there's probably going to be, I haven't read there for next year, a bump in terms of carryout, but that's on an expectation we'll get more acres and at least the normal growing season and reasonable type yields. But still, it's a tight scenario as it persists on barley. But I think from an end user's perspective and from a grower's perspective, we've been used for a generation or more of looking at our barley market as almost a captive audience here in Western Canada. The vast majority of it is going to be fed locally. There's no question. That's not changing. But in the old environment on marketing barley, the Wheat Board had a lot of difficulty capturing opportunities offshore because there were periods of time where the offshore market generated a premium for the barley market. Maybe it was a short period, maybe it was sporadic. Most of the time our domestic market was more highly priced, and so the product would stay here. But those opportunities got missed, and the board maybe did 200,000–300,000 tons of barley for export in a given year in the last number of years. But it couldn't get the price signal to the grower that, hey, we got this great opportunity, it's short term for limited tonnage, but if you commit to me, we can take advantage of it. The board couldn't transmit that signal through its pros and otherwise, so those opportunities got missed. In the new more open market environment with multiple competitors now, I think you're probably going to see more of that happen from time to time when the offshore market generates that sporadic and temporary premiums, that they'll go out in the country and try to secure that commitment from the grower. And I think that's what we saw this year, where we saw the offshore market move up into the, got above 250 and got into the 320 or so US a ton range at FOB Vancouver type price, where the offshore market started moving up, and immediately we committed about 700,000 tons to the grain companies for offshore movement. Now, I think the domestic market realized what was happening here. We better not get short of supply, and we saw our domestic cash prices move accordingly. So we got $5, $5.50 in some cases in southern Alberta, just over $6 a bushel for feed barley at its peaks. So we had that movement happen very early, not because we were necessarily short on barley, but we wanted to stop it from going to the offshore export market. And that's what the private trade has accomplished during this. And again, fortunately it happened during a bullish cycle. Looking ahead though, so I think we need to be more aware of what's going on in the export market than we used to about barley, because it's going to influence the price more than it did in the past under the old monopoly regime. So we have to watch countries, and one that I have particular interest in these days is Argentina, who in the blue bars here on top, who had not been much of a player in the export market up until recent years, and a lot of that has to do almost as a protest of the Argentinian farmer, who have been taken advantage of by their government. I got no other way to explain it than that, but they have, the Argentinian government wants to control domestic wheat supply and have artificially restricted export flow from the Argentinian farmer. They have put export tariffs of about 20% of the value of the farmer's wheat to restrict that flow out of the country. And I can only imagine if our federal government tried to put a 20% export tariff on our Canadian wheat, what kind of protests we would have. There would be rioting in the streets. And that's essentially what's happened, rioting in Argentinian streets by the farmers there. And some of the response to this has been, well, we're going to grow something else. If you're going to restrict my wheat price and ability to export, we're going to grow something else. So it's corn or soybeans, and in this case, more and more barley is being planted down there, peas as well. So they're diversifying their options in that country, and wheat production is falling as a result of this. But the Argentinians, again, there's a lot of focus on the market now on their corn and soybeans, which are going in the ground. Delayed planting issues because it's been very wet there. It's somewhat delayed. It's delayed for sure, and there's some worries as to what it may affect. But there's a wondering if it's affecting what wheat and barley that's already in the ground there. So there's a question mark as to how much exportable supply Argentina is going to have in the year ahead. If they are curtailed in their supply, maybe there's some room on the offshore market to the upside yet to be realized. But under this expectation, where they're going to be a fairly big player, whether it's 800, 900,000 tons, the offshore market may be somewhat curtailed, and that limited upside suggests to me that the barley market may be limited on how far it can go relative to the peaks we have already seen. Cash Lethbridge price at very high levels. Again, the upper 95 percentile of where we've been. I'm 75% sold on feed barley to this time. I spoke on feed grains at the Canfax conference in Calgary about a few weeks back, and I had the chance to chat with a few of the feedlot interests about where they were, and it seems like they bought a reasonable amount of barley during the fall period. Of course, maybe they're talking their positions to me. I got to keep that in mind as well. But they wanted to reserve some barley and just have been nibbling away at the spot market to satisfy their needs, looking to hold that supply for their Jan, Feb, March period, what their needs may be, to fill any gaps that may arise during that time. So, you know, I look at cash feed barley prices. I think locally maybe they're on the 5.25, 5.35 area. Deferred positions into start of spring is maybe 5.60-ish, 70-ish or so. You know, those are pretty good pricing opportunities. I don't think this market's falling away on us anytime soon. You know, there's strong underlying support, but I want to meter sales into that just in case we get big production expectations in the year ahead. Oilseeds, canola. Again, where we are relative to history. I'm 70% sold on old crop right now. I haven't done anything on new crop yet. But I think on all these ag markets, we are operating, in a sense, within a new generational paradigm. For my clients, I've written many times in the past year or two about what I consider here the 2-2-2 philosophy. 2 year up, 2 year down, 2 year sideways. 2 year up, 2 down, 2 year sideways. We could see where 2008 certainly led the marketplace, at least for a brief period of time, and now we broke down in 09 and 10 before the next upcycle began, and then according to the end of 2012 here with the U.S. drought gave us our next bump up to about 650 futures at its peak. But we've been in this rally cycle now on canola for about 2 years. And I don't want to be hard about the timing of things, but we'll just be aware we are in the midst of that kind of cycle. If we get crop-related problems next year, well, all bets are off. Is it 14? Is it 16? Is it 18 or more canola dollars a bushel? That's hard to say. But historically speaking, we're at pretty attractive levels. But I think we have gone through a new paradigm shift here that happens again once every generation. Last time this happened was probably in the 1970s. Where here in the past 25 years or so, we've been trading a range in canola. At the worst of times, looking at maybe $300, as low as $280 futures on the very bearish of times, and then $450 on the upside. I think we're going into a world now where the old highs become the new lows. So the 450, 500 area potentially is the lower end of the marketplace. Upside, we're too early in this, and I'm just theorizing, to be honest with you. But I think we have made that shift, and part of that shift has become the use of biofuels in agriculture. And this kind of chart I could show you, it was the same on the barley, but it was on corn and soybeans as well. But more biofuels has become a new component of the demand element of the marketplace, speculative money that's in these markets, so it's changed the perspective of the canola market. From our fundamental point of view, again, ending stocks here look very tight. We have a very strong demand component to the canola market that's just charging ahead here in the first half of the marketing year, and it's eating supplies up at a very good clip. But I look at where the soybean market is, because canola doesn't operate within a vacuum of its own fundamentals. It has to operate in competition with other vegetable oils and oilseeds, like soybeans and palm, cottonseed, sunflowers and such. You know, we've had the major spike here and ran ahead of us here, the soybean market, ran ahead of the canola market, got up towards $18 a bushel, sold off about $3.50 a bushel since that peak at the end of August. You know, canola wasn't as impacted on the downside, but it didn't go up as quickly as the soybeans. But, you know, we are caught in that ebb and flow of the broader oilseeds and vegetable oil market. So I have to be certainly aware of that. This graphic in bars is South American production. in the line is for U.S. production. And you can see where South American production fell probably about 20 million tons short of what expectations were before the La Nina event affected Brazilian, Argentinian production. This year, there's very high expectations yet again. The crop is a little behind in terms of getting in the ground, but also in delayed seeding, particularly in Argentina, corn is the first crop to go in. If it gets delayed too far, they're going to switch to soybeans, so it'll actually mean more acres to soybeans potentially going in. But again, the crop is a wild card right now, and it's going to be certainly one of the dominant issues driving the oilseed trade and price discovery as we're moving through the winter heading towards next spring. Ending stocks for the world. The U.S. is tight, or projected to be very tight on soybeans. From a global perspective, doesn't look quite as tight. However, this is, like I say, the drop from the previous year to this current marketing year. Expectation for next year growing a little bit, but built into this is the prospect of a record-sized, large South American soybean crop. That's no guarantee at this stage. I remember at this time last year, the South American crop was looking actually pretty good. It wasn't until January, February where the La Nina effect, weather conditions had affected soybean production in South America. So a lot of potential wild card left in this environment. But what I look at is the vegetable oil market as well, because canola is a very high oil content oilseed, much more so than soybeans. Soybeans depends on its value of the meal more so than the oil. Canola is the opposite. Oil is the strong determiner of the canola seed value. Meal is important as well, but oil is the trigger. And when I look at the Malaysian palm oil market, palm oil is the largest by volume vegetable oil traded internationally in the world. It accounts for about 60% of vegetable oil trade. So it's a big player in that context. And they're in a situation, Malaysia, Indonesia right now, with record supplies of palm oil, record ending stock projections, and you could see the trend that this market peaked around April, May, fell down, maybe bounced around here during the summertime with U.S. drought considerations and such, but then got into September, fell down again, and tried to come up and almost made, we're hoping, was almost a little double bottom thing, but in the last week or three is broken down again, is trading down at contract lows. Again, red flag. Maybe I better be selling some canola. I know I'm bullish on canola, and we're going to be tight here, but I'm just looking at from the macro perspective of conditions there. On soy oil, which canola rides fairly in line with, you could see this market also peaked in September, at the start of September, broke down, stabilized for a while in October, broke down again, and looks like it may be bouncing. Maybe 47, 48 cents a pound is the bottom, and it's bounced, but all I can say right now is this is a bounce within a declining market. That's all I can call it right now. So I have to be wary of that scenario. And I look at the crush margins of the domestic crushers here in Canada. Canola is holding up relatively, canola seed prices, while off from their highs, are holding up relatively well in respect to other competing products, but it's tightening the crush margins of the crushers here. It hasn't affected the pace of the crush yet. The demand's still chewing through that inventory, but I got to look at where the potential is on this thing. So I know, and I talk to growers, well, there was talk of 16 million tons of canola, and we got maybe 13.4 now, according to the latest StatCan report, and tomorrow will be the final numbers out of StatCan. Be interesting to see what they have to say. I'm not expecting a giant change. Personally, I'm thinking it might be up a little bit relative to the 13.4 one made in October, but it won't be enough of a change to impact the marketplace. But I know growers have a mindset, particularly a lot of guys I talked to in Saskatchewan who had difficult yield considerations this year, that our supplies are down. Our price can't go anywhere but up. But that's too much of a localized thinking. Canola will maintain a price premium relative to other oil seeds because of that tight supply, but this tightness of supply does not, the Europeans, the Chinese, and the Australian harvest that's ongoing right now are not necessarily that tight on canola. It's only Canada who's tight. And we've had a very aggressive buy program when back in June, July, August, more like, well, probably May, June, July, where the trade was thinking we were going to have a 60 million ton crop, record ballooning acres in Western Canada. They started an aggressive book for the domestic crush and for export. They started selling, expecting all that canola to come in the fall time. And that product was supposed to move right now. And so that's why you're seeing creative basis, strong basis opportunities in the current market. You're seeing creative basis in the sense of a company making a commitment that commit your canola to me now, I'll give you a strong basis, say off the July 2013 contract, and then you can deal with the futures how you want, price it whenever you want. You just deliver that canola to me now. Because the need for it is today, not further down the road, to satisfy all the business that's already on the books, that's been done months ago, but now it's time to ship it. And that's what we're seeing in today's market. This is going to start petering off pretty soon because we can't continue at this pace. We will run out of canola. We'll go into negative on the carryout at the pace we're going right now. It will start slowing down. So, but like I say, the marketplace still is offering good prices historically, but I have to look at those variables. I have to look at the soybean situation in the United States. I was writing about this when we had our peak in September and we started breaking down and got into this territory. Again, I moved to, I was about 70% sold. I about 50% sold when this breakdown happened, and I was writing to my clients that, look, this has the potential of head and shoulders type top to it. If that is indeed what is happening, we can expect, as we typically we do seasonally in the canola and U.S. soybean and corn markets, when 50% of the crop gets harvested, we tend to get a seasonal bounce in the market. Farmers sell immediately off the combine, we get to about 50% harvest, and things start to slow down. We get some type of seasonal bounce. If that was going to happen, I was kind of hoping we could knock the soybean market from what at the time was $15 a bushel and maybe get it back up to $16.50 to give us another shoulder on the top there, and I was going to sell another increment of canola. Well, the market gave us a small little bounce, but started to fail, and I didn't like what I was seeing, so we sold another 20% to get us to 70%. We're looking at cash prices at the time about $13.50, $13.75, which is kind of where we are at the moment. And so we just did another increment, and the market has broken back. It looks like it's stabilizing again, but is this something I call the makings of the next bull market? Not yet. All the fundamental variables that got us to here are done supply-wise. That's already in the market. In order to get this market fired up again and challenge those old highs is going to require a new bullish catalyst, whether it's a failure of the crop in South America or a failure or threat of failure in North America in the coming year. That's just an unknown variable and not one where I'm looking at a cash prices of $13, $14 canola, historically speaking, very high price. I don't want to hold too much unpriced inventory at the highest prices I've ever sold canola at, on the hopes there's going to be a crop failure somewhere else. So, yes, keeping some gambling stock. I got about 30% or so. See what the winter develops, and we'll evaluate the situation accordingly. Because when I look at the canola price chart, the uptrend's broken. We were going for a year along this steady incline. It's been obviously choppy and volatile, but we broke the trend line. This is no longer a bullish market, if you look at it strictly from this perspective, from the chart perspective. It needs something else to give us the new momentum to the upside. Can it be realized? Absolutely it can. But we have to see how things progress going into the next year, and I just didn't want to hold too much unpriced inventory under that kind of scenario when we're looking at very profitable crop prices. And I'll look at the weekly price chart as well because it tends to give me longer term perspectives of trends in the market. When we broke below that $600 level, that's when we did our last cash sales, and now are sitting at 70%. I haven't done anything on new crop yet, and I know that everyone has $14 bushel in their mind these days, an expectation that that's where the price should be. But 2 years ago, and it was only 2 years ago, we were $8.50 to $9 canola. It wasn't that long ago. So we have an expectation that this is the new reality and this is the way it should be. But if we do get a big bump in production next year, and again, I'm not saying that's what's going to happen, but the threat of that, that's why I'm as aggressively sold on old crop. I haven't done any new crop, but if we have potential to get, say, $12.50 a bushel on new crop, I may just start that first increment. I'm making money at $12.50. I'm going to give it its first shot. If it's the worst price I see in the year, so be it. This is going to be a great year for all of us. But incremental sales into a rising market is something I've always valued, rather than trying to hit the home run and think I can pick a top. Okay, that kind of provides my bigger, broader roundup of how I see the ag commodities shaping up in the present time. I'm still optimistic for the year ahead. I think there's that South American crop, how it's progressing through the winter is going to be a big driver for oilseed prices, however, and all markets. But we tend to kill a crop at least 1 or 2 times before it gets harvested. So there's bound to be weather scares shape up over the course of the season. But I definitely think there's going to be pricing opportunities that are going to be attractive to all growers as we get into the next cycle. But I just want to offer that word of caution that if we do get a breakaway from the past 2-3 years of successive rounds of major crop-related problems around the world, if we get into a more normalized production cycle around the major players in the world, we might be looking at a somewhat different pricing market than we're looking at in today's environment. But the volatility will be there, so we'll have sporadic opportunities to do some pricing on. So with that, I do wish you the very best in the year ahead, and thank you very much for your time.